Welcome back to another Friday Five. Today is July 28th, and we are finishing this month with a big bang. Here's what happened this week. You may be well aware on Wednesday, the Federal Reserve concluded their two-day meeting, and they ended it with a nice little rate hike. It was expected, and it came in at 0.25%, just as expected. The interesting thing, though, was it did not really impact mortgage rates. And typically, when the Fed hikes, that is a good thing for mortgage bonds. I know that's counterintuitive, but it's a good thing for mortgage bonds. Therefore, it's a good thing for mortgage rates. What we've seen, though, over the last 6 or 9 months, as these rate hikes have taken place, is bonds are not reacting in their traditional fashion. Then again, it kind of seems like nothing is acting normal lately. Well, following the Fed meeting and the lack of a response from interest rates to the Fed decision, we got a great inflation report. And I say great, it's all relative, right? But we were expecting, the markets were expecting inflation read to be 4.2. It came in at 4.1. It's a tenth better than their expectations, which continues to give credence to the fact that inflation is coming down. As inflation comes down, this is good for mortgage bonds. And what's good for mortgage bonds is good for rates, meaning rates should be coming down with inflation. But once again, we just didn't see much of a reaction in interest rates. And that's because there's other economic factors, some of which are happening across the pond in other countries. And that's weighing on our currency and our markets and our numbers as well. So that data is having a struggle right now in winding its way and finding its way into the bond market and helping our interest rates. There's a couple places people can go look and see what the gauge is on interest rates. And obviously, interest rates are different for each person, each situation, and it's based on a number of characteristics. But Freddie Mac puts out a primary mortgage market survey each week, and they give a read on what the consensus is for interest rates. This is a backward-looking index because they are asking this week, they're going to publish it next week. So next week, when you read about it, it's old news. Their number was, or their rate that they're showing is 6.81%. And then Optimal Blue, this is a pricing engine that a lot of mortgage companies, both brokers and lenders, use this vehicle to help price their loans. Optimal Blue is actually capturing rates that people get locked in or registered. They're publishing a 6.85% rate as of just a couple of days ago. And then we have Mortgage News Daily, which is a very reputable firm that provides information to our industry, and they were citing 6.95. Rates are really clinging close to that 7% handle, and they just don't want to let go. And this is a lot of people troubled, people that are trying to buy homes. They're really struggling with that 7% handle. Now, while interest rates are high, you and I both know that a lot of people are sitting the fence. They're thinking the market's going to crash, and there's going to be this just plethora of homes on the market at depressed values, and there's going to be all these foreclosures. Well, let me just share a little bit of information with you about potential foreclosures. 49% of mortgages are considered equity rich. So those are going to be people that have 50, 60, 70% equity in their property. Probably not likely to be foreclosed upon. Reason being, they will find a way out. They're going to protect that equity. In fact, when we look at the foreclosure numbers, across the country, we are less than 3%. So I don't see a crash. Now, that doesn't mean that one isn't coming. I don't see it. The numbers just do not show that. We are heading into back to school season. We know that the market is going to start shifting just a little bit with people being preoccupied with getting kids off to college and getting back to school. If you've got any clients that are sending kids off to college, this is a perfect time to have a conversation with them about buying a property near the campus, renting it out to your kid and 3 of their friends or 3 of their buddies at school, keeping that property for the duration of the college term, perhaps even putting the kid's name on it to help them build some mortgage credit. And then when college is over, sell the house. You've now paid for your kids' room and board, or at least their room, built up some equity, and perhaps that equity could actually pay off the college expense. Hope you found that tip useful and love to hear from you. Let me know if I can help you. I am around to help you with any of your buyers that are out looking this weekend. So give me a shout or drop me an email. Talk to you soon.